Hey, this is Gary Collins, the creator of the Primal Power Method, and today we're going to be talking about finances. A little different topic. People are going, what does this have to do with health and nutrition? But people's major stress point is finances and money. So we want to talk about that and have people have financial independence and more freedom in their life, which will make them happier, which will make them healthier. And that's the whole point. And Shawn Perkins is here with me today. He is a financial advisor and mortgage broker. He financed my first home when I was a young lad in my 20s, starting out in my federal government career. And it went very well. Obviously, that's why we still talk. And he works for a company called Principal Shield Financial. And we're going to talk over 5 ways in which people lose money. And today, we're going to go over the first one, which is how you choose to mortgage your house, which I think everyone can deal with because a lot of Americans obviously own homes. So would you kind of expand on that and explain how people are losing money financing their house?
Well, you alluded to something early on, which was that I've seen in many people that I deal with 5 common areas in that they lose money, that they're transferring their wealth away from their own circle of wealth, as we call it. And those 5 ways are how they choose to structure and pay for their mortgage, how they choose to pay their taxes, how they choose to save for their retirement, how they choose to save for higher education, and then the last one is how they choose to pay for their major capital purchases. So area number 1, how they choose to structure and pay for their mortgage, is that many times when people buy a home, they'll delay buying a home because they think they have to save a 20% down payment to be able to buy a home.
Yeah.
So they can cost themselves money by waiting to buy a home instead of buying the home today at $300,000. If they choose to save money for the down payment, it might take them 5, 6, 8, 10 years to come up with that money. And then what's the house worth then? If the home value has gone up to say $375,000, you've waited 8 to 10 years to save the 20% down payment, but now you're paying a significantly greater amount for the home, and that costs you money. So how you structure your mortgage is you give a larger down payment than what is necessary, and that means that money is no longer available to you to do other things that might be more beneficial to your financial profile, whether that's increasing your savings for retirement, whether it's financing debt that you could otherwise not finance with credit cards and things like that. It could be paying a higher interest rate on your mortgage than you could be paying if you were to refinance. It could be consolidating non-tax deductible debt, credit cards, car loans, and things like that, into a mortgage that has a much lower monthly payment and allows you to write off the interest. So there's several different ways that people may be losing money within how they choose to structure and pay for their mortgage.
That's a very interesting point. I actually, the first loan we did was a VA loan, and that for my first place. And what was it then? I want to say, was it 3% down, or was it 0? You know what? I financed the whole thing. I think I didn't put anything down.
0 down. No,
yeah.
It has been,
Yeah, and you're right. I actually made good money off that place. It was right at the beginning of boom, and yeah, I did well. And you're right. But after that, I did finance my houses putting 20% down, and the last one, it got me. I lost all that money, and that's an interesting point. That if, say, something happens in your life to where you cannot pay that mortgage, or you have to get rid of the house, short sell it, or just get rid of it. You're totally right. You're going to lose money if you put that 20% down. And I've gone the opposite way now, of where I'm paying for my house cash because I have to. You know, I didn't have a choice. I'm building a place off the grid, and there's no financing it.
Right.
So that's an interesting point. I've done the math. I want to get your perspective on this. I've done the math on a home long term if you finance it, and it's kind of a tricky situation, because if you do it over the long term, the interest that you pay over 30 years, which very few people today own their home for 30 years. So I'm on your side on, hey, put the least amount you have to put down as you can.
Right.
Because if you do finance a house and go long term, the math I put together, you don't make any money. When you go to sell the house, you basically break even at best, because all the finance charges ate all of your profit. and then all of the upgrades and all of the upkeep and remodels, because you'll probably remodel your house twice during that 30 years. And heck, people in California spend 150, $200,000 remodeling a house today.
You bet.
Yeah, so that's a very, very interesting point. And I've gone the other way now of pay your smaller debts off first. Is that what you prescribe to? Is don't stick it all in your house. Pay off your car, your credit cards, and maybe smaller debts, as opposed to having a big chunk of money sucked up in a house?
Well, yeah, it's interesting that you say that, because I just wrote a series of blogs that they begin with, one, is your house a good investment? And I address exactly what you just talked about. I'm not going to say that real estate is a bad investment, but it may not be quite the investment that people think it is.
Oh, yeah.
The reality is that your house that you choose to live in is really more of a lifestyle decision than it is an investment. And then the piggyback to that series of articles is your house a good place to park your wealth, as I refer to it? When you put a down payment on a house, when you make extra principal payments, or whether you just make the principal and interest payment on your mortgage, every month you're placing a portion of the principal into your house that, in this case, the bank would require on a regular payment, extra principal if you send extra money. And that's what we call a balance sheet neutral decision.
Okay.
You have $5,000 in your checking account right now. You take that $5,000 and pay that much extra on your mortgage. You haven't improved your financial position in any way, shape, or form. You simply have moved money from a liquid, safe, accessible form in your checking account into your house, if you will, where now you can't get to it in the event that you had some kind of emergency, you needed the money.
Yeah, that's a very, very good point.
You already mentioned the other side of it is, if there is some kind of a downturn in the market, now that money's gone. Because if you put $5,000 in your house and now $5,000 a drop in your home comes, you've lost that money.
That's a very valuable, especially out here in California, in places where houses are very expensive. So for most people, they barely get by. And I've always told people too, is if you have to negotiate your house payment and you're trying to figure out a house that's, a certain price and you can almost afford it, but not quite, you need to get out of that range. You're especially the real estate agents, they love sticking you in the biggest, most expensive house they can. If you're cutting it close to where you cannot possibly make that payment, that is a bad, bad decision. And then on top of it, if you throw all of this money into the initial payment, the down payment, now you're doubly screwed. And I'm going to be honest, my last house cleaned me out financially. I had something come up, and I had spinal fusion. I couldn't work. I was laid up for over a year, and I put down 20% in a house that I could afford, but I should have never spent that kind of money. And I lost almost $250,000 in my last house, and I mean cash gone, cannot make it up. And trust me, it's embarrassing. I felt like a complete idiot because I've always handled my finances myself. I've always done very well. I made money on every single house I've owned prior to that. And I just got sucked up in that whole California dream thing, coming back here. And I got sucked in the market and something went wrong, catastrophic, and I was screwed. And the banks were not going to work with me. You know why they wouldn't work with me? Because I put 20% down and they already had their money. They could care less if I got foreclosed on or not. They had made their money and then some.
Well, and I also want to preface that what we're talking about is not a right or wrong issue.
Yeah.
It's a right or left issue. It's about efficiency as opposed to inefficiency. If somebody puts 20% down when they buy a house, or they come into an inheritance and they take that large sum of money and they pay down or pay off their mortgage, that's not a right or wrong issue. It is simply whether it's efficient or not. Does it give them the benefits that they ultimately want?
Yeah.
And that's what I want you to understand, is that you didn't make a mistake by putting 20% down. You just maybe weren't as efficient. You might have put yourself in a compromising position that at the time you couldn't see as being possibility in the future. But isn't that what makes them unexpected emergencies, crises, if you will? is that we don't know that they're going to happen.
Yeah.
And the thing is, we put ourselves in a situation where we're unable to handle that crisis when it does happen because we did what we thought was the right thing, putting a big down payment, sending extra money on our mortgage, and so on.
Well, and that's what it did too, is it didn't allow me to ride out that significant life event, because the money that I needed to get by during that event was tied up in my down payment in my house.
Right.
And it was even worse for me because we discussed I had a VA loan. I could have used my VA loan again. And instead, I went with a more conventional loan and put the 20% down. And not to mention,
so why did you do that?
You know, it was because I had the money and I just didn't see this life event happening. It was just, I couldn't, it caught me, I just got caught out of left field. I just didn't see this occurring.
Well, no, but I mean, why did you decide to go with a 20% down payment if you knew you could go with a 0 down payment? What was your reasoning behind that?
Lower house payment. And like I said, what I should have done, but the problem was too, is I was buying at a time in the market where there was nothing cheap. I was probably buying in one of the cheaper, decent neighborhoods, but I probably should have reevaluated. And I bought the house for resale. You know, I bought the perfect house that fits in that Goldilocks zone of which most people are looking for, but was probably bigger than what I needed. And so I thought it through, and I thought it was a good idea, and it turned around and bit me right in the butt. And that's a good point too, is even as you can plan for everything, sometimes stuff just goes wrong. And you know, but that I agree with you now. I'm one of those people that a house and a payment is just life if you're going to finance it. And that money can be spent elsewhere much more wisely. I mean, if you can get down your credit card debt, own your cars free and clear, that's a huge deal. I mean, that's a lot of stress taking off. And you just realize that your house payment is your house payment. Yeah. You know, that's something that is very difficult for Americans to get out of. I mean, very few can go debt-free and own their house free and clear while they're still working, you know, while they're still in the prime of their working years.
Yeah. Well, and some of the things that people need to consider when they have money and they have something they want to do with that money is you want to consider the safety of the money that whatever you're putting the money into. So if you're going to put the money into your house in the way of additional principal payments or a large down payment or a large inheritance that you're paying down the mortgage, ask yourself, is the money that I'm putting in my house, in quotation marks, safe? Well, if the value of your house can go up or down based on reactions to market situations, then it's not safe, because if you needed to sell the house, as you referenced, in a down market, then you've lost that money.
Yep.
What makes the money safe is being able to time the sale at a point when the market value is up, so you get your money back. But most people that are in a situation where they have to sell their house can't control the timing of the sale.
No.
They need to sell now.
Yeah.
So your money's not safe because you're subject to the fluctuations of a market you have no control over, and many people don't even understand it. The second thing people need to consider is the liquidity of that money. And you just alluded to that too. If you need access to that money and you move it from your checking account into your house, how liquid is it? How quickly can you convert that wealth in your house, your equity, to cash in the event that you have a circumstance you didn't plan on? It's not very liquid. And the funny thing is, lending guidelines are designed to prevent access to that cash when circumstances arise that necessitate needing that cash.
Yeah.
So I need to get to the equity of my house, but because of the situation I'm in, I can't get to it.
Yeah, well,
because the lenders won't loan me the money, whether I lost my job or I had a health issue. So the third thing people want to look at is rate of return. Mortgage money is very favorable. Today we're looking at interest rates of 3.5% to 4%. It's the cheapest money out there you can borrow. And if it's so cheap, why are we in such a rush to pay that off? Especially when you consider that it's the only tax-deductible debt we have left besides business interest. Okay, so why would you want to get rid of the only tax deduction that you have left and the cheapest money that you can borrow when you have credit cards and car loans at higher interest rates than the mortgage?
It totally makes sense. You're absolutely right, and I think we get caught up in things, and with that, what's your opinion about people using that buying power and getting an equity line on their house and then turning around buying a car, a boat on that because it is cheap money? For me, if I would rather people not do that in the lifestyle that I teach, because you're purchasing items that you really can't afford, and they go outside the scope of that original mortgage, which is a lifestyle issue. Your boat is not truly it's a lifestyle issue, but it's just to keep up with the Jones. You know, it's not something
not an
that exactly. It is a item that is going to lose money as soon as you get it.
Right.
Yeah.
And so to answer your question, I've been in this business for 23 years, and in that 23 years, I've seen several up and down cycles in the real estate market, and the most recent up, as you know, was from 1997 all the way through to 2007 before the crash in 2008.
Yeah, I know it very well.
And all the way up to 2007, I saw a lot of equity lines of credit driving down the road, cruising across the bay down in San Diego Harbor, because people were using their equity to buy cars they couldn't otherwise afford. In the area that I live in, it's a fairly middle-income America, and I'll tell you, I see more BMWs, Lexuses, and Mercedes in this area than I think I've ever seen anywhere else. And I know the people that live here cannot afford those vehicles without having taken out some of their source of income, which is they pulled the equity out of their house. Yeah. Same thing with buying a boat, buying jet skis, desert toys, toy haulers. They use the equity in their house to finance a lifestyle, and that's not what the equity in your house should be used to do. The equity in your house is your wealth, and it should be used to improve your financial position. And so if that can get rid of other debt that's not tax deductible, if that can be used in the way of taking that money out and giving yourself what I call an emergency reserve, most people have heard of it as a rainy day fund. You should have a rainy day fund of anywhere between, say, 3 to 6 months worth of your living expenses, so that if life's little unbudgeted emergencies come up, you're not destitute. You're not loath to find a way to get out of it without losing your house or losing your car. And most people don't have that. In fact, the Wall Street Journal recently reported that 70% of Americans are living paycheck to paycheck.
I saw that.
Regardless of their level of income.
Yep.
And what goes hand in hand with that is 76% of Americans have less than 6 months of their living expenses in an emergency reserve. That means only 24% of Americans are really financially able to handle a crisis if it came their way.
Yep.
And that means you're putting yourself in a serious financial situation that you may not even realize until that event happens. And that's the worst time to find out how ill-prepared you may be financially. Well,
and not only that, but it's a perfect example of, I've known people who have gone through that situation, you know. I know what it did to my health. My health was absolutely deplorable for, you know, to include back surgery and everything else I had to go through. You know, the stress level it put on me was the worst stress I'd ever been in my life. You know, I've been in the military and law enforcement, and that incident was the most stressful I'd ever dealt with. So that is absolutely a true statement. And I think people will learn from this. I hope that from this series people get to understand too, is this is to help you throughout your entire life. This is to put all the pieces together, to put the health pieces together, the happiness pieces together, and understanding financial wellness. Because I think that's one thing too, is we're not taught very much in school. You know, that's one of the things we're never given the tools and told about. I mean, I didn't learn about a mortgage until I met you, Shawn. I never learned that in school. I never learned how it worked. I mean, I wasn't a business major. I know business majors will get some of that. But for the most part, 99% of Americans don't even know what a mortgage is until they get one.
Yeah, you learn about it going 65 miles an hour down the, into the brick wall.
Yeah, that's when you got to buy your first house.
Yeah.
And I remember, in my 20s, and, I was pretty good at math, and I remember going, wait, how's all this work now? Let's slow this down. You get your truth of lending statement, your first, and it's pages and disclosures, and there's numbers all over the place. And I think that is something to learn from it, too, is take your time, work with a good professional. Work with someone who you can trust. Just don't jump right in and get a mortgage. I actually walked out of a signing for a new house I bought several years ago because the guy changed everything after I walked in. I got my truth to lending, and it was different. And then I walked in, which they used to do back in the day a lot. Today you'll get your butt handed to you if you try and do that today.
Yeah.
But yeah, actually, I had to turn around and walk out of there and go get my mortgage through my my credit union, and I had to do it within like a day. So yeah, make sure it's someone you can trust. And I did trust the guy, but it was pretty shady. So do your research too. I always tell people, just like health, go out there, take your time. You know, what would you say, Shawn, far as interviewing lenders or mortgage brokers? Go out and find three to six and go out and talk to them and kind of weigh and see if you can, you know, if you have a good relationship with them or not.
Well, where I tell people to start is, first and foremost, work with somebody that you personally know and trust.
Yeah.
You have a relationship with them already. If you don't have somebody that you personally know and trust and have a relationship with, then talk to somebody that you know and trust and see who they know and trust and have direct personal experience with. So a referral is always the best way to go.
Yeah.
Because you know them and you trust them, and if it's not the person you're working with that you know and trust, then the person you know and trust has somebody they know and trust. So there's really two ways right there. The last thing you should be doing is dialing for dollars, answering, going with some lender you see on the television or on a radio ad. You want to make sure that you have a reason to trust that person. We are far too willing to give our trust to people today because they're slick talkers. They sound really good in what they're talking about, but we don't have any reason to trust them from experience. We have no reason to believe that what they're going to do or what they say they're going to do is actually what they do.
Absolutely, and that goes, I preach that in health all the time, and working with personal trainers and where you buy your supplements and where you get your food from. So it all ties hand in hand. It all goes together. This big circle comes back. And I really appreciate it coming on, Shawn. We're going to have at least 4 more financial series on the Primal Power Method website and my blog. Shawn, where can people get a hold of you if they want to use your services or contact you?
We were talking about blogs. My blog is at www.wiseandwealthyblog.com. They can read individual installments and bite-sized pieces of the things that we're talking about. They can reach me by my email address at Shawn, SHAWN, at principalshield.com. Principal is PRINCIPAL, shield.com. And then, of course, they can reach me on my mobile number, which is my business, is 619-994-1110.
And I'll have all that information on my website. It'll be contained within the blog for everyone, so if you want to get a hold of Shawn, you'll be able to. Again, thanks again, and I look forward to our next installment.
Thank you, Gary. I appreciate it.